Thank you very much, Luke. Good morning, everybody. I'm going to talk about a number of issues affecting individual taxpayers. And just to say that I think Jason and Luke have already stolen the best of the Halloween puns, so I won't be making any, which is probably a good thing. So, despite all the speculation, this rather overcrowded slide shows that as far as your income tax position is concerned, nothing has really changed. Moreover, the Chancellor has made the decision to protect working people from being dragged into higher tax brackets by confirming that income tax thresholds and national insurance contribution thresholds will be unfrozen from 2028-29. Likewise, there were no changes to national insurance contributions for employees and the self-employed. So, phew, no reversal of the last government's hefty cuts on NIC. Again, despite plenty of rumours, pensions tax reliefs during lifetime remain very attractive. The annual allowance is still £60,000. Surprisingly, you still get income tax relief on pension contributions at your marginal rate of tax. There's been no adjustment to the top threshold for tapering the annual allowance, and if you're already in drawdown, you can still put in £10,000 a year. The lifetime allowance charge, which was abolished by the last government, again, perhaps surprisingly, has not been reintroduced, and dearest to many people's hearts, the 25% tax-free lump sum has been retained, albeit it is capped at about £270,000, but that was already the case. But inheritance tax is quite another story, and I'll leave my colleague Samantha Stent to explain the issue there. And finally, QROPs, or Qualifying Recognised Overseas Pension Schemes. This is a bit of a niche point, but some people were managing to get double tax allowances by transferring pension funds into QROPs in the European Economic Area or Gibraltar, and that idea has been quashed with immediate effect. A few other income tax points: individual savings accounts or ISAs. The annual £20,000 contribution limit has been retained and will be there till at least April 2030, and that's £40,000 for a married couple, so do please use it or lose it on an annual basis. But the additional £5,000 UK ISA, which Jeremy Hunt had proposed, that idea appears to have been dropped. The high-income child benefit charge, just to remind you, if the highest earner in a household has income of more than £60,000, then child benefit is gradually clawed back, and if the income is more than £80,000, it goes altogether. But you could have a household with two people earning £60,000 each, £120,000 in total, with no clawback, which is manifestly unfair, and it had been proposed to put that right. But actually, that proposal's been dropped as well, and the unfairness persists. And then something really spooky, making tax digital MTD for income tax. Already in place for VAT, but it's coming down the road very rapidly for sole traders and landlords with gross income, note gross income, not net profits, of £50,000 or more from April 2026. From April 2027, it will catch sole traders and landlords with income of more than £30,000, and by the end of this Parliament, those with income of more than £20,000. And the problem with MTD is it will require quarterly tax reporting rather than just annual as now, and the use of dedicated software, and that's perhaps why its introduction has been delayed more than once. But if the can isn't kicked down the road further, it's coming pretty rapidly. And finally, the changes to the non-dom regime. You'll recall that Labour had been calling for changes to the non-dom regime, and despite Jeremy Hunt having said that he wasn't going to make any changes, he rather shot Labour's fox back in March by introducing changes. So firstly, what is a non-dom? It's essentially a UK tax resident whose permanent home is actually still outside the UK. And under the current rules, non-DOMs can decide whether to be taxed on their foreign income and gains only if they're brought into the UK, what's called the remittance basis. And Labour, and indeed many of the general public and the press, saw the existing regime as unfair, and Rachel Reeves herself had said, quote, "I believe those who live in the UK should pay tax in the UK." So the announcements yesterday largely follow what Jeremy Hunt announced in March, which means that from April 2025, non-DOM status is to be axed. But anybody, whether they're non-DOM or indeed of UK origin, coming to the UK after a period of at least 10 years non-residence will not be taxed on their foreign income and gains for the first 4 years, foreign income or gains, or FIG. This could be very helpful if you're looking to attract high-paid employees from overseas. The measure also applies to individuals who arrived here in the last couple of years after a long-term non-residence from April 25, so they may still be able to take advantage of a FIG for a year or two. And in a bid to encourage the bringing of foreign assets into the UK, there's also the Temporary Repatriation Facility, or TRF, and this enables non-DOMs who've previously accumulated untaxed foreign income and gains by using the remittance basis to bring those funds into the UK at a flat tax rate of only 12% for the first 2 years, or 15% in year 3. Other changes with regard to non-DOMs: they'll no longer be protected from tax on foreign income or gains arising in settlor-interested trust structures, which is actually going to have a lot more effect than it sounds. The domicile approach to inheritance tax is being replaced by a residence-based system. So anyone present in the UK for at least 10 of the previous 20 tax years will be caught. And anyone leaving the UK will remain within the IHT net for between 3 and 10 years after they leave. For capital gains tax, current and past remittance-based users will be able to rebase any foreign assets that they held at 5th April 2017 to their market value at that date, which will be helpful. And finally, overseas workday relief. This allows non-DOMs to escape UK tax on their overseas earnings as long as they're not brought into the UK, is being reformed slightly but broadly maintained. Now, the Treasury have been hoping that these measures won't scare people away from the UK, although speaking to one of our guests earlier today, he mentioned several clients who've already decided to go. That aside, they're hoping that the FIG regime and the temporary repatriation facility will bring more funds into the UK. And this slide shows the OBR's assessment of the impact of the measures, totalling $12.5 billion over the next few years. So just to wind up, or maybe wind you up, did the Chancellor meet her pledges to working people, whoever they may be? I think, Pache, Luke, that on one level she did, because she hasn't increased direct taxes on income that people derive directly from working. Lifetime tax reliefs for pensions remain attractive, but listen out for the inheritance tax sting in the tail. Making tax digital is just around the corner, so do all please check whether you are going to be affected, if so when, and work with your advisors to make sure that you're ready. And finally, it's goodbye to the non-DOM regime, but remember that there are new benefits to be had for anyone coming to the UK after an extended period of non-residence.